6 billionaires left California before breakfast on January 1st. Another 20 are packing right now.
Well, a billionaire backlash is brewing in California over a proposed bill that would tax the ultra-rich, with some reportedly ready to move their businesses and their money across the country to Florida.
Silicon Valley's wealthiest residents are once again threatening to leave California, this time over a proposed state wealth tax. Now, the proposal would impose a one-time 5% tax on the assets of California residents worth more than $1 billion. It would require residents to report their total net worth, including property, investments, businesses, and other assets, so the state can tax overall wealth, not just income.
California just lost more wealth in 3 weeks than most countries generate in a decade. The wealth walking out the door exceeds $1 trillion. Governor Newsom is watching the state's entire tax base evaporate in real time, and the ballot measure causing the exodus hasn't even been voted on yet. Just the threat of a 5% wealth tax sent Silicon Valley's richest residents running for state lines faster than anyone predicted. Here's what makes this different from every other rich people leaving California story you've heard.
Now, if the measure qualifies for the November ballot and is approved by voters, it would apply retroactively to anyone who lived in California as of January 1st, 2026.
The tax has a residency clause that anyone living in California on January 1st, 2026 would owe 5% of their entire net worth if voters approve it in November. The liability gets locked in based on where you lived on New Year's Day, not where you live when the tax passes. That turned December into the most expensive moving month in American history. Larry Page didn't just buy one Miami mansion, he bought two in the same week. A $101.5 million Coconut Grove estate came first. Then a $71.9 million property less than a mile away landed days later. Google's co-founder simultaneously formed Florida-based entities under his family office. Every legal connection between Page and California got severed before midnight on December 31st. Florida has no state income tax and no wealth tax. For someone worth tens of billions, that saves hundreds of millions yearly before the proposed 5% even enters the picture. Peter Thiel waited until New Year's Eve to make his announcement. Thiel Capital opened a Miami office. The PayPal co-founder registered to vote in Florida. Thiel has called wealth taxes economically destructive for years. Announcing on December 31st wasn't about timing a press release. It was about beating a deadline. David Sachs runs Kraft Ventures and used to live in San Francisco. On December 31st, he announced his firm opened an Austin office. He'd already relocated earlier that month, carefully timing everything ahead of January 1st. His announcement never mentioned the wealth tax. It didn't need to. Texas has no state income tax, no capital gains tax, no wealth tax. Let me know in the comments if you'd stay in California or move to save potentially hundreds of millions. Sergey Brin hasn't made anything official yet. Real estate sources say Google's other co-founder is looking at Miami waterfront property. No deal has closed, but watching your business partner buy $173 million worth of Florida real estate probably gets you thinking. David Lesperance runs a firm that specializes in one thing: moving ultra-wealthy clients out of high-tax places. He personally walked 4 billionaires through establishing residency outside California before the cutoff. He can't name them because of privacy agreements, but here's what matters. Behind them are at least 4 more who moved quietly. Devesh Makan founded Iconic Capital, which manages money for Silicon Valley's tech elite. He personally knows 4 or 5 families that left before January 1st. His prediction? Another 15 to 20 billionaire families exit if voters approve the tax in November. California has about 200 billionaires total. Losing 25 to 30 households means over 10% of the state's wealthiest tier disappears in 1 year. The measure aims to raise $100 billion one time. The Service Employees International Union United Healthcare Workers West pushed it forward because California faces a $190 billion Medi-Cal funding shortfall over the next decade. Federal healthcare cuts created the gap. Union leadership says billionaires whose fortunes exploded recently should help fill it. The money would go to healthcare, education, and food assistance programs. Some billionaires aren't running. NVIDIA CEO Jensen Huang says he's perfectly fine paying if it passes. He chose to live in Silicon Valley and accepts the taxes that come with it. Developer John Sobrato is worth $11.8 billion and staying put too. He thinks the measure will fail at the ballot box. But they're the exceptions. Most aren't waiting to find out what happens in November. They're relocating now because the math is brutal. Someone worth $2 billion owes $100 million. Someone worth $10 billion owes $500 million. Moving costs money and effort. Staying potentially costs 9 figures. The ballot initiative still needs roughly 875,000 valid signatures just to appear on November's ballot. Then it needs voter approval. Then it faces guaranteed legal challenges. Governor Gavin Newsom publicly opposes it, creating a rare moment where the Democratic governor aligns with the California Chamber of Commerce. Both are fighting the tax, but for different reasons. Newsom fears economic damage. The chamber fears what it does to California's business reputation. The proposal got revised in November to address early criticism. The original version required billionaires who left before the deadline to still pay 75% of the tax. That changed to the hard January 1st cutoff. The authors also added expedited legal procedures, routing challenges straight to the state Supreme Court for faster decisions. David Gamage, who teaches law at the University of Missouri, co-wrote the proposal, and his reasoning is straightforward. The healthcare funding crisis hits this year, so revenues need to arrive quickly. Fast-tracking court cases doesn't solve the constitutional questions, though. Legal experts are questioning whether applying this retroactively even works. How does California accurately value someone's net worth? The proposal uses book value plus earnings multiplier calculations for business interests. It sets strict rules about charitable pledges and trusts. For billionaires with holdings spread across multiple entities, calculating exact net worth gets extraordinarily complicated. The measure includes a phase-out between $1 billion and $1.1 billion in net worth. Someone worth exactly $1.05 billion pays a reduced rate compared to someone worth $1.1 billion. But determining that precise valuation when you own private company shares, real estate portfolios, art collections, and complex business structures becomes nearly impossible. Then there's the liquidity problem. Startup founders whose billions exist entirely in private company stock can't easily convert that to cash. A founder worth $2 billion in unlisted shares can't generate $100 million liquid without destroying their company's valuation. Selling that much private stock floods the market and tanks the price. Or they'd need to take the company public early just to access liquidity, which triggers massive capital gains taxes on top of the wealth tax bill. The proposal allows paying over 5 years with interest, but that just spreads the problem across 5 years instead of solving it. This creates twisted incentives throughout Silicon Valley. Founders planning IPOs now have to calculate timing against potential tax exposure. Going public in 2026 and crossing the billion-dollar threshold before the November vote could mean an unexpected 9-figure bill. Delaying IPOs or keeping companies private longer hurts employees relying on stock options for their wealth and reduces liquidity for early investors who've been waiting years for an exit. The wealth tax doesn't just affect billionaires. It warps decision-making across the entire startup ecosystem. The economic impact reaches far beyond individual tax bills. California's own state analysis shows the wealth tax could generate tens of billions one time but cost hundreds of millions yearly in ongoing revenue if billionaires relocate permanently. Those billionaires pay income taxes on their earnings. They pay capital gains taxes when they sell assets. They pay property taxes on their real estate. Their companies employ thousands of California residents who all pay income taxes. Their investments fund startups that generate economic activity and create more tax revenue. Losing billionaires doesn't just eliminate their personal tax payments, it eliminates entire economic ecosystems built around them. William Stern founded Cardiff and sees the core problem clearly. California's top 1% pays nearly half the state's income tax revenue. That creates catastrophic dependency. Chasing away the golden goose with a wealth tax isn't a political argument. It's basic math. When the tax base leaves, the money to fund roads, schools, and public services still needs to come from somewhere. That burden shifts downward to middle-class residents who can't afford to absorb it. Michael Moritz is a billionaire venture capitalist who criticized Representative Ro Khanna for supporting the tax. Moritz pointed out that 40% of California's tax revenue comes from 1% of its residents. Supporting this proposal amounts to economic self-destruction. He suggested Khanna should focus on eliminating waste and fraud in state government instead of driving away the people funding it. Khanna fired back by calling for audits of all 50 states and promising to work with the Oversight Committee on Government Waste. The exchange shows the deep split even within California's Democratic Party. Progressives view the wealth tax as necessary redistribution. Moderates view it as economic suicide. Suzanne Jimenez serves as Chief of Staff for the Service Employees International Union United Healthcare Workers West, which sponsored the initiative. She dismissed Exodus warnings as overblown fear-mongering.
For the last couple of weeks on social media, we've seen a lot of debate on this. The New York Times reported that venture capitalist and co-founder of Google, Larry Page, as well as venture capitalist Peter Thiel, are seriously considering leaving the state. What's your response to that?
You know, there are always these kind of chicken little arguments whenever there are tax policies like this being proposed.
She pointed to Jensen Huang's willingness to pay as proof people aren't actually scared. She claimed that real-world examples of similar tax policies show people don't actually leave states over this. California's advantages are too valuable to abandon.
And when we look at real life examples of these kind of tax policies, none of that ever materializes. So as an example, in Massachusetts, they moved a millionaire's tax. And there were lots of kind of rumors and speculations that millionaires were going to flee the state. And when the tax passed, it actually was the opposite. And so now there are more millionaires in the state of Massachusetts. And so I just think kind of the swirl that is happening right now around the California billionaire tax is kind of the same argument. And we really believe that the benefit from this tax is going to outweigh, maybe a couple people moving out of the state, because we're really heading towards a healthcare crisis.